Think about the products you use every day. You know, the soap, the shampoo, maybe the mayo you put on your sandwich. Most of us grab these things without a second thought. Yet, behind so many of these staples, there's often one, well, huge company working away quietly. Today, we're taking a deep dive into that very company, Unilever.
Exactly. And our mission here is to really unpack Unilever's business quality, how it's lasted so long, its competitive advantages, which are pretty formidable,
Right.
and also how its leadership is navigating some pretty interesting challenges right now, and of course, its financial health. We've gathered a lot of material investor reports, sure, but also insights from employees, customer reviews.
Yeah, and those reviews get pretty passionate both ways.
Oh, definitely. Some love, some not so much.
And that's what makes this so compelling, I think. We're looking at how a company that's, over a century old?
Yeah.
How it's trying to reinvent itself? We'll get into the surprising truths behind some brands you definitely know, and why some customers are absolute fans, while others are, really let down.
Yeah.
So let's peel back the label and see what really makes Unilever tick.
Okay, so to really get Unilever, you first need to understand its basic DNA, right? What it is.
The foundation.
At its core, it's a massive consumer goods company. They make and sell a huge range of branded products. And these aren't luxury things.
No, everyday stuff.
Exactly. Mostly low-cost things people buy often. Things you need for daily life. Hygiene, cleaning, basic food items, stuff people always need.
So how do they actually make money? Is it just volume?
Well, volume helps, but the model's pretty straightforward. It's the margin between the selling price and all the costs involved, making it, marketing it, R&D, getting it onto shelves everywhere.
Okay.
But what's really key and relatively recent is this big strategic shift they made back on July 1st, 2022. They totally dismantled their old structure.
Ah, the famous matrix structure. Heard it was pretty complex.
Oh, notoriously so. Bloated, complex, those were the criticisms. They replaced it with 5 clear, distinct business groups, each focused on a category.
Makes sense. What are they?
You've got personal care, that's the biggest, about $13.6 billion in 2024. Then foods, very close behind at $13.4 billion. Beauty and well-being, around $13.2 billion. Home care, just over $12 billion. And ice cream, still pretty significant at $8.3 billion.
So a big reshuffle. Was it just moving boxes around?
No, it was a very deliberate overhaul. The goal was to be simpler and faster, like they said, more responsive, directly tackling that bloated and complex reputation.
And this structure underpins their big plan now, right? The growth action plan.
Exactly. It's the foundation for that. And the basic model itself has amazing endurance. Over 100 years, they've been selling stuff people need.
Hygiene, cleaning, food.
Right. Things 3.4 billion people use daily. It's almost certain people will still need soap and detergent and, basic foods in 10, 20, 50 years. That stickiness is a huge built-in advantage.
Okay, so that's the business. But how do they defend it? With that kind of scale, how do they keep competitors from eating their lunch? What's the fortress?
The economic moat. Yeah, their fortress really stands on 2 main pillars, and they reinforce each other. Intangible assets and cost advantages.
Intangible assets. That's got to be the brands, right?
Absolutely. Those iconic global names everyone knows. Dove, Hellmann's, Knorr, Rexona, Homo, Magnum. The list goes on.
Yeah, you hear Dove, you think soap or body wash.
Exactly. It's like they own mental shelf space, built over decades, and they spend a fortune maintaining it. Think about this. 9.4 billion euros on advertising and marketing in 2024 alone.
Wow, 9.4 billion just on marketing.
Just on marketing. And they're smart about it, too. They focus heavily on what they call their power brands.
Okay, what are those?
These are their top 30 brands, the real heavy hitters. They account for over 75% of the company's total sales.
75% from just 30 brands.
Yeah. And interestingly, those power brands grew faster than the rest, up 8.6% in 2023, shows that focus and investment pays off.
Okay, so strong brands are one pillar. What's the other? Cost advantage.
Right. And that's all about sheer scale. Unilever operates this absolutely massive global distribution network. They're in 190 countries.
90.
Yeah. And they reach something like 4.4 million retail stores just in their top emerging markets. Think about the negotiating power that gives you.
With suppliers? With retailers. Huge leverage.
Exactly. Plus, they get efficiencies in manufacturing and logistics from their 7 global operational hubs. It all adds up.
So brands plus scale equals pricing power.
That's a big part of it. Look at 2023. They managed to push through widespread price increases, adding almost 7%, 6.8% to be exact, to their underlying sales growth. That's the moat in action.
You can see with specific brands too, right? Like premiumization.
Definitely. Dove is a great example. They launched higher-end lines like the Dove Serum Shower Collection or the Scalp Plus Hair Therapy. People trust Dove, so they're willing to pay more for these premium versions.
But it's not unlimited power, is it? There must be limits.
Oh, for sure. Even strong moats have limits. Take their ice cream segment. Volumes actually declined by 6% in 2023.
Why was that?
Prices went up, and consumers basically downtraded. They switched to cheaper ice creams. So even for beloved brands like Magnum or Ben & Jerry's, there's a point where price sensitivity kicks in hard.
Okay, so the moat is strong, but not impenetrable. So is it getting wider, staying the same, maybe shrinking? What's the trajectory?
I'd say it's stable, but they are definitely making a deliberate, pretty aggressive effort to widen it. Management themselves admitted competitiveness was disappointing.
Really? They said that?
Yeah. Only 37% of their business was actually winning market share in 2023. They're losing ground in some areas to rivals like P&G and also to private label store brands. So there's a real sense of urgency.
And that urgency drives the growth action plan, the GAP.
Precisely. That's the playbook to widen the moat. Key parts are, first, focusing investment money and that huge marketing spend on those 30 power brands.
Right, doubling down on the winners.
Second, pushing for unmissably superior innovation. They're spending nearly €1 billion a year on R&D. They're even using AI, and get this, quantum computing, to help develop better products.
Quantum computing for soap. Okay.
Hey, whatever gives you an edge. Third is active portfolio management. They're getting rid of brands that don't fit or are slow growing.
Like Dollar Shave Club?
Exactly. Dollar Shave Club, Alita Beauty, the Suave brand in North America, those are gone or going. But they're also buying smaller, high-growth brands in premium spaces like K18 hair care or Liquid IV supplements. Bolt-ons, not huge deals.
Sure. And fourth?
Strategic simplification. The biggest example is spinning off the entire ice cream business. That should be done by the end of 2025. Makes them simpler, more focused.
And how do they stack up against the competition, numbers-wise?
Well, looking at late 2023 data, in consumer non-cyclical goods, Unilever had just under 30% market share. P&G was ahead at over 37%.
So number two there.
Yeah. In personal and household products specifically, Unilever was just over 30%. Still a giant, absolutely. But P&G is a formidable rival, and it's a constant battle.
Okay, let's shift perspective. Let's do some scuttlebutt, as investors call it. Get the view from the ground. Customers, employees. This is often where you find the real story.
And with Unilever customers, it's fascinating. You see this real split. Deep loyalty, almost love on one side, and some pretty vocal disappointment on the other.
Tell me about the lovers first.
Well, you see generations of loyalty for core brands, people calling Dove their fave, their holy grail, saying it's the only thing gentle on skin. Elman's mayo fans call it the GOAT, the greatest of all time.
The only mayo allowed. I think I saw that quote.
Exactly. Or people raving about Ben & Jerry's non-dairy options, calling them life-changing. Real passion there.
But then the disappointment.
Yeah, and it's often quite specific. People complaining that formula's changed. Dove soap doesn't feel the same. Hellmann's tastes different. Quality control issues pop up, like deodorant cans that don't spray properly.
Annoying stuff.
Very. And sometimes new products backfire. People reported rashes from a new Dove whole body deodorant and Ben & Jerry's. Some longtime fans insist the quality dipped after Unilever fully took over, saying it's gritty or airy now.
That's tough feedback for everyday products people rely on. A small change can feel big.
It really can. And beyond the products themselves, you have the ethically concerned customers.
Right. What are the main issues there?
Two big ones stand out in our sources. First, organized boycott calls over Unilever staying in Russia after the 2022 invasion of Ukraine. Second, persistent criticism, especially from groups like Greenpeace, about their massive use of single-use plastic packaging.
So this gap between, say, their purpose-driven marketing and these actions, does that hurt them?
It's a definite risk. That say-do gap, as you call it, can erode that precious brand equity and potentially limit their pricing power over time if it gets bad enough.
Okay, that's the outside view. What about inside Unilever? What are employees saying? There seems to be a contrast there, too.
A big contrast. Officially, Unilever presents itself as this amazing employer, right? Purpose-driven, Great pay, flexible work, parental leave, wellness programs, big on diversity and inclusion. They boast high employee engagement scores, like 79%, and 87% saying they're proud to work there.
Sounds pretty good,
But then you look at anonymous forums, like Reddit discussions among current or former employees, and you hear things like bloated, bureaucratic, inefficient. One person mentioned being on projects with 200 plus nameless, faceless colleagues.
Wow, that sounds stifling.
It does. Others describe the culture as intensely competitive, high pressure, even toxic. People feeling they have to throw others under the bus to get ahead, leading to burnout, poor work-life balance.
That doesn't sound like the official picture at all.
Not really. Even the hiring process gets called dystopian, involving weird gamified tests.
So this internal dissonance, the gap between the stated culture and the reported reality, that must have consequences too.
Absolutely. If you have widespread burnout or intense internal competition, that's bound to stifle innovation and make it hard to keep your best talent. And Unilever actually acknowledges talent retention and organizational efficiency as risks in their own reports. So the internal culture really matters for their turnaround plan.
Right. Let's switch focus now to leadership and financial strength.
Yeah.
Big changes at the top recently, haven't there been?
Yes, a period of high urgency, you could say. Heinz Schumacher came in as CEO in July 2023. He was an external hire.
And he kicked off the growth action plan.
He was the architect of it, yes. Focused on those power brands, trying to build a stronger performance culture. But he was only there until February 2025.
Pretty short tenure.
Very short. His replacement suggested the board wanted to accelerate its execution. They were impatient for results.
So who's in charge now?
Fernandez took over in March 2025. He's the opposite of an external hire, a 30-plus year Unilever veteran. He was the chief financial officer before becoming CEO.
An insider. Does that signal a different approach?
It signals, I think, a focus on speed and precision, using deep knowledge of the company. Fernandez calls himself a frontline CEO. He's all about in-market execution, demand creation. His goal, he says, is to create desire at scale.
Create desire at scale. Sounds punchy. What are his main tools?
Two big levers stand out. One, a major push into premium products wants to get that segment from 35% of the business up to 50%.
Ambitious.
Very. And two, a massive pivot to social-first marketing, using influencers heavily. He even talked about aiming for one influencer in each of 5,764 municipalities.
Yeah, that's specific geographic focus.
Yeah, he's clearly targeting the U.S. and India as key growth markets. Huge potential there.
Okay, new leader, clear focus. How have they been handling the money? Capital allocation, has it been sensible?
Looking at the track record, yes, it seems remarkably rational and disciplined. They've definitely stepped up reinvestment in the core business. Brand and marketing investment, BMI, hit 15.5% of sales in 2024. That's a decade high.
Putting money behind the brands.
Yeah, exactly. And R&D spending is consistent, nearly €1 billion a year, feeding that innovation pipeline.
What about buying and selling companies? M&A.
They've been very clear, no huge transformational acquisitions. Forget about massive deals. The focus is squarely on smaller bolt-on acquisitions that add value, especially in those high-growth premium areas.
Like K18 Hair Care and Liquid IV.
Perfect examples. And at the same time, they're actively trimming the portfolio, selling off slower brands like Alita Beauty, Dollar Shave Club, Suave, plus the big ice cream demerger planned for 2025. It's about focusing the portfolio.
And returning cash to shareholders.
Yep, reliable dividend payouts. And they started a new 1.5 billion share buyback program in 2024.
So overall, sounds like textbook good management.
It really looks like a textbook example of an owner-oriented mindset focused on creating long-term value if you look at the numbers over the last 5 years.
Yeah, give us the highlights.
Revenue's been pretty steady, between low 50s and up to near 61 billion. CapEx is stable around 1.5 to 1.8 billion. R&D, like I said, consistently near $1 billion. M&A swings around a bit as they buy and sell things. Dividends are rock solid around 4.3 billion, and buybacks have increased recently. It paints a picture of disciplined management.
Okay, disciplined management. What about the underlying financial strength? Is the business itself really robust? Can it handle bumps in the road?
Oh, yes. Unilever is what you'd call a highly reliable earnings machine. Even with challenges, net income has grown, on average, about 4.4% per year over the last 10 years.
Steady Eddie.
Pretty much. And what's really significant right now is the gross margin. It expanded hugely in 2024 by 280 basis points, hitting 45.0%. That's a 10-year high.
45% gross margin. That's strong.
Very strong. And that recovery is crucial to their strategy. It's what's funding that increased brand investment we talked about.
Right. It creates this potential virtuous cycle. Higher margins, fund more marketing, which builds brands, supports prices, helps margins.
Exactly. That's the goal. And you see the quality in the key ratios, too.
Like ROIC, return on invested capital.
Yeah, ROIC is a great measure. Unilever's averaged a really strong 15.5% over the last 5 years. Recently, it was 16.3%. Now, compare that to the average consumer staples company, which might be around 5% to 8%.
Wow, big difference.
Huge difference. It's powerful proof of their competitive edge and how well they use their capital.
And cash flow, are they actually generating cash from those earnings?
They are a cash machine.
Yeah.
Free cash flow was $7.1 billion in 2023, $6.9 billion in 2024, and crucially, their free cash flow often comes in higher than their net income.
It's a good sign, right? High-quality earnings.
It's a classic hallmark of high-quality earnings. They aim for about 100% free cash flow conversion, and they usually hit that or beat it.
And the balance sheet, debt levels.
Managed very prudently. They aim to keep net debt around 2 times their underlying EBITDA. They're comfortably within that target, well away from danger levels. Plus, they have strong single-A credit ratings, plenty of financial flexibility.
So if you put those key ratios, gross margin, ROIC, cash conversion, debt together over the last 5 years, what's the story?
The story is resilience and recovery. Gross margin dipped, but bounced back strongly. ROIC shows remarkable consistency in the mid-teens, always good. Cash flow is consistently strong, mostly over 100% conversion. And debt levels are stable and sensible. It's the financial dashboard of a very sound, high-quality business.
Okay, we've covered a lot of ground. Business, moat, people, leadership, financials. Let's get to the bottom line for someone looking at this today. The price versus value question. Mid-2025, how's the valuation looking?
Right now, the price-to-earnings ratio, the PE, is running around 23 to 24 times the last 12 months' earnings. The price-to-free cash flow ratio, PFCF, is about 17 to 18 times.
And how does that stack up historically for Unilever? Are those numbers high or low?
Well, compared to its own history, that PE of 23-24x is definitely at the higher end of its typical 5-year range. It's been down around 16-17x at the low end.
So maybe a bit pricey on an earnings basis.
Potentially, yeah. But the price-to-free cash flow ratio, around 17-18x, that's actually pretty much in line with its historical median, which is about 18.4x. So the market seems to be valuing its strong cash flows more reasonably, perhaps?
So putting it all together, bargain bin or fully priced? It's a judgment call.
Our analysis suggests the current price looks, well, fair, but probably not compellingly attractive. It doesn't scream bargain.
Not much margin of safety, maybe.
Exactly. It feels like the current price already bakes in a reasonable chance that this turnaround plan under Fernandez will succeed. So it's less about buying something cheap and more a bet on excellent future execution.
A bet on execution. If that's the case, what's the most important thing driving future growth? What should people watch?
I think the single most important driver you can point to is the successful premiumization of their portfolio, especially led by those 30 power brands.
Making people want to pay more for better versions.
Essentially, yes. Leveraging that billion-euro R&D spend for genuinely better products, and then using that social-first marketing to really create desire at scale, as Fernandez puts it. If they nail that, you get volume growth and margin expansion, especially focusing on the US and India. That's the engine.
Okay, that's the upside case. What about the downside? What are the real risks that could permanently damage the business, even if execution is okay?
There are 3 big ones, I think. First, the turnaround and premiumization strategy just fails. Consumers say no thanks to the higher prices, stick with cheaper options, or the innovations don't hit the mark. That could mean stagnant volumes, falling margins, or real hit to their earning power.
Okay, strategy failure. What else?
Second, permanent brand damage. Imagine a massive product safety recall or a huge public backlash over plastics or, say, their stance on a geopolitical issue escalating significantly. If that permanently tarnishes a core brand like Dove or maybe Ben & Jerry's, that would be devastating. Trust is everything for them.
A blow they might not recover from. And the third risk?
Third is just failing to keep up with how people shop and discover products. Not mastering e-commerce, quick delivery, social commerce. Especially with younger consumers. If they lose relevance there, they could permanently lose access to customers and market share.
Big risks. So how does the wider market see Unilever right now? What's the general feeling?
The consensus narrative seems to be one of cautious optimism. It's mostly centered on this self-help turnaround story. People generally agree the steps in the growth action plan make sense. The new CEO is a positive.
So they expect things to get better.
Yeah, but gradually. Kind of linear improvement. Yeah. Most analysts expect underlying sales growth to get back to maybe 3-5% a year, with some modest improvement in operating margins. Ratings are generally hold or buy, nothing too dramatic expected.
Okay, that's the consensus. Is there a different way to look at it, a potential contrarian view? What might the market be missing?
Well, here's a thought. What if the market is underestimating the potential for improvement that's not linear, especially on the cost and efficiency side? Remember the scuttlebutt about the internal culture, the bloated, inefficient organization? The consensus focuses a lot on sales growth, but maybe the bigger near-term opportunity is actually an operational leverage.
Getting more profit out of the existing sale.
Exactly. You have a new CEO, Fernandez, who's an insider, knows the company inside out for 30 years. Maybe he's the one uniquely positioned to finally cut through all that internal complexity with surgical precision, as they say.
Ah, so unlock hidden efficiencies that the market isn't fully appreciating yet.
It's possible. If they can achieve a significant, maybe unanticipated improvement in productivity and efficiency on top of hitting their sales goals, well, then the earnings and free cash flow growth could be substantially higher than what's currently priced in.
And that would make today's fair valuation look potentially quite attractive down the road. Interesting angle.
It's something to consider.
So, wrapping this up, we've seen Unilever as this giant with deep historical roots, huge scale, but also a company right in the middle of a really crucial transformation. It's balancing that decades-long brand loyalty against changing consumer tastes, ethical demands, and trying to align its official story with what some employees actually experience. It's complex.
It really is. A business touching billions of lives, facing very modern challenges to stay relevant and trusted. It's a reminder that even the biggest ships need to navigate carefully.
Their ability to adapt really seems key.
Absolutely. It's often the truest test of enduring quality for any business, big or small.
So, a final thought for you listening. What do you think will ultimately matter most for Unilever's future? Is it that deep, almost ingrained trust in brands like Dove or Hellmann's that they've built over generations? Or is it their ability right now to genuinely adapt to this fast-moving world of social media, instant commerce, and much higher ethical scrutiny? How do you see those powerful forces playing out for a company woven so tightly into our daily lives?